Hello and welcome to the Monday Futures Market Outlook for March 4th, 2013. This is Patrick Ceresna. As always, we start off with a chart of the US dollar index futures, and we've seen a substantial breakout. We were looking for even initially for the US dollar to hit overhead resistance along its previous highs as the euro was coming into a support. But clearly, at this stage, the trend higher in the US dollar remains to be very dominant. We've taken a very neutral stance on the US dollar going into that overhead resistance, but with this breakout, there now really is room for the US dollar to find higher levels. Now, that's over the last month since February, we've really seen that US dollar trend be quite intact. At some stage, there will be throwbacks where we could see even 1 or 2 points pullback on the dollar index. But really, at this stage, we may now have seen really a new trend in place that may end up over the next few months seeing the US dollar clearly trading at the 84.50 level on the upside. So we'll watch as this continues to develop. Next year, when we take a look at that euro, the euro really did break that 31.50 support that we were originally looking for. Really at this stage, with us now seeing a breakdowns below the 130 level on the downside, the next really good support doesn't come in until the 127.50 area, where the lows came in November. At this stage, we do still anticipate there to be a zigzag in here, and we could at any one point see a pop back to 133 or 132 on the upside, but the downtrend now is getting pretty predominant, and we do expect that every rally will most likely be faded. Next year, when we take a look at that 30-year Treasury bond, we see that the Treasuries did put in some sort of a bottom, and we are now seeing a bigger reversal. Now, this 30-year doesn't demonstrate it as much as the 10-year, which has really turned around much more distinctly, and that was all basically on Ben Bernanke's comments. And so really at this stage, we most likely have seen a bottom in bonds. This is a very big and important piece of information, because the last major bond rally that we had all the way, if you look to the on the chart all the way to the left, that was stimulated by comments from the Fed, and as well, more importantly, it led to a stock market correction. So this inverse relationship of bonds to stocks may once again be a leading indicator of the fact that a market correction may become underway. Next year, when we take a look at copper, we saw copper put in its highs, and now it really is just going to come down to the first layers of support down below. With that US dollar breaking out on the upside, there's plenty of room for copper to still deteriorate lower, but we don't believe that shorting copper makes much sense here at this point. While it's more likely here that we're going to start bouncing at support, and even if it does deteriorate lower, it'll be a very methodical process down. It's unlikely to be just a very sharp, aggressive selling. And so really at this stage, what we say is we're probably a month or two away from any opportunity to accumulate copper, and so we must just let it finish bottoming out. Next year, I want to take a look at crude oil, and crude really has also put in a top, and ever since that US dollar began trending, that crude has really weakened really at this stage as well. We don't think that shorting crude now makes a lot of sense, but at the same time, there is room for a few more dollars on the downside. If it really accelerates, we could see as much as $5 on the downside as it now comes to the bottom end of the range. But it doesn't even have to get that low. We're not necessarily going to be buyers of crude on the dip, but we do think that the selling at some point here will start to stall out. Next year, when we take a look at the chart of gold, gold more or less tested its lows from May and June and July of last year. And really at this stage, this is a place where gold does have the chance to put in a bottom. Now, if we have any early breakdown below this 1577 level on the downside, we could still see yet another full retest of that 1550 level down below. But overall, we think that there are support lines here that should hold gold prices in. Finally, when we take a look at the S&P 500, the blue box zone is the zone that defines that area where we believed all along and still continue to believe we will see the majority of the stock market put in its tops, the upside being around the 1550 level. Now, we've seen already some good waves of selling, but it doesn't mean that the market is not yet going to try one more time to test that upside. We do believe a more meaningful market correction is around the corner, but we could spend the first few weeks of March, or even going into the tail end of March, very much still just banging out a market top, and then the correction would subsequently follow. So really at this stage, a double top retest on the upside, or even a short-term rally that goes towards 1550 and then sells off, is something that we would not rule out. And so, but at the same time, as we can see the market make these little bursts higher, it may spur investors to feel compelled to get into the marketplace. But I think that would be ill-advised at this juncture. Any rallies on the upside should be used only as opportunities to distribute the market and not to accumulate. At some juncture, once there is a much more meaningful market correction, we'll be looking to be buyers. Just to make some key intermarket observations, we didn't change our stance on the US dollar yet, but our long-term trend may actually become an uptrend, and we're contemplating changing that over the next few weeks. At the same regard, we don't want to shift the US dollar short-term risk reward back to good, as the US dollar is on the short-term overbought, but particularly if we have any short-term selling in the US dollar that represents a buy on dip opportunity, we will change that risk reward proposition in that favor. Now, commodities have been very range bound, but they are now slowly approaching the bottom of the range. We don't want to suggest a good risk reward proposition yet until we see something that resembles bottoming formations in the market, but really at this stage we'll stay very middle of the pack there. The US bonds, we definitely look like we've seen a reversal, and it may actually begin an uptrend, so watch for us to change that trend to an uptrend if it continues to develop. At the same time, the US stocks and global stocks have been in pronounced uptrends, but the risk reward proposition of owning them at this moment is quite poor, and we are not actively in the markets at this point from that perspective. That was your Monday Futures Market Outlook. Thank you for joining me.